Hi, I'm Chance Finucane, Chief Investment Officer at Oxbow Advisors. Now that we're about a week past election night, we wanted to walk through how we're looking at the stock market and our own equity portfolios today. We don't structure our portfolios for a particular election outcome, and you're not going to see us make a bunch of trades now that we've seen the results come in. We don't think that any one outcome is going to be either good or bad for the stock market. In fact, if you look at the last 90 years, the number of years has been pretty evenly split between periods when one party had control of both the White House and both sides of Congress, and periods when power was split between the two political parties. And if you aggregated the years in those two scenarios and looked at the average annual returns in the stock market, they're pretty much the same. We also noted that in a past interview, Warren Buffett was asked how political outcomes affected his investment returns. And he pointed out that for around half of his career, the person in the White House was the person that he voted against, and yet it didn't seem to bother his returns too much. So we're not going to worry too much about this election as it regards to total stock market returns. We're also not going to worry that much about which industries are going to be the winners or losers based off of this election. That might be a good trade for about a year, but as you stretch out to a longer time horizon, industry and economic factors are going to play a bigger role. If you look at the 8 years that Obama was in office, as well as these past 4 years with Trump in office, in those two periods, it was the same two sectors that were the best performing and the same two sectors that were the worst performing. Tech and consumer discretionary on the best performing side, and financials and energy on the worst performing side. We also can look at when Trump was elected 4 years ago, two industries that investors became more positive about were banks and coal. For banks, it was the idea that deregulation was going to unlock more profits for these businesses. And that worked for about a year, with bank stocks appreciating by nearly 60%. But at that point, the economic headwinds that banks have been facing for the last decade started to take over, and bank stocks began to underperform for the last 3 years. And if we look at bank stocks over this past 4 years, the total return has been okay, of about 33%, but that's more than 50 percentage points behind the S&P 500. As for coal, Trump has been an ally to coal producers, and that helped in the first year with coal stocks going up about as much as the market. But since then, the structural headwinds in that industry, with power grids shifting more to renewables and natural gas for its energy needs, has proven too strong to fend off, and coal stocks have been coming down ever since. In the last 4 years, coal stocks are actually down more than 20%. Which means they've underperformed by more than 100 percentage points in the last 4 years versus the total market. For us, we don't focus on this 12-month time horizon. We're focused on the next 5 years, and in particular, we hone in on two variables. First is continuing to monitor the companies that we like with strong competitive advantages that are operating in attractive, growing industries. And we're going to continue to monitor them so that if they start to trade down to prices that we think are attractive, we'll be able to buy them for our portfolios. The second variable is monitoring the starting valuation in the overall stock market. If you look at this chart, the forward price to earnings ratio of the S&P 500 is about as high as we've seen it going back to the dot-com bubble in 2000. What this tells us is that there's a lot of optimism already priced into the marketplace around a recovery coming from this pandemic. And given that, we wouldn't expect more than about a 5% annual return at best over the next 5 years if you invested in a total stock market fund. So for us, we're going to continue to follow the companies and industries we like with a 5-year outlook rather than focusing on these next 12 months in whichever trade everyone else is chasing. And we're going to keep our expectations low about future returns given how high starting valuations are today. We hope this gives you an idea of how we look at the stock market when there are major news events happening around us. If you have any questions, please contact us.